Hi, I'm David Bodemer, the Editorial Director with National Real Estate Investor. I'm here with Don Mackinnon from ARC Realty Finance Trust. How are you?
Doing very well, thanks.
So we're at the Commercial Real Estate High Net Worth Investment Conference. You were just part of a panel that was talking about non-traditional real estate investment. So what were some of the highlights of that discussion?
I think it was a very lively and good discussion. I think what we learned on there is there's a lot of opportunity in the marketplace. There are different ways to go about alternative investments in commercial real estate, whether it's going on the opportunity side, which is typically has very low current yields, but you're expecting overall higher returns, to the side that I play on, which is more about good, durable current income, sleep well at night investments. There's a wide range of opportunities really in commercial real estate today. We're at the right part of the cycle for investing up and down that risk curve.
And so what exactly do you specialize in? And you're part of ARC.
My specialty, I have spent, since I got out of graduate school in 1990, I have been in the commercial real estate debt markets.
Okay.
I run American Realty Finance Trust. It's really the newest generation of offering by ARC. It is a commercial mortgage REIT, so it is right along my line of expertise. It's one of 10 different product offerings that we have. The majority of those are single strategy focused REIT vehicles, whether it is a net lease vehicle, grocery anchor shopping centers, New York focused, global net lease. And then we have a business development company that is obviously not a REIT vehicle and invests in lending to middle market corporate America. So we have a whole series of strategies. The fundamental premise behind all of the strategies is that they are single focused, that they are durable income, that they are sleep well at night investments.
And it's a non-listed REIT?
Yes, this is a non-listed REIT that I am managing. The majority of our vehicles start that way.
Right.
The intention when you start one of these vehicles is really three questions are asked. A lot are asked, but it boils down to three, and that is there an opportunity in the marketplace to deploy $1.5 billion to $2 billion of capital in this specific strategy?
Right.
Is the management team in-house, or do we need to bring in a management team, or perhaps partner with a best-of-breed management team? And lastly, what's the exit strategy for this?
Right.
Because these are all about providing durable income, but also, at the end of the day, giving investors the comfort that we have thought through this and there are viable alternatives, whether it's a sale of a company, whether it's listing on an exchange, or some other form of an exit strategy that will get the investor money back at the end of the day with the return.
And so this trust is at the beginning of the cycle, correct?
We are early stage. The Realty Finance Trust went effective with the SEC in February of this year. We broke escrow with our first investment in the month of May. We declared a distribution rate of 8.25%. So first vehicle, we are early stage in capital raising.
And the investment strategy, like what kind of markets, deals are you looking for in terms of building this thing out?
That's an excellent question. We're looking in the United States. We are a lender to income-producing properties, so no home loans, no land, no construction loans. It's all income-producing properties. Income that can pay the mortgage that can pay the distribution, okay, across asset types. So we'll have diversity by asset type, diversity by sponsor, diversity by tenant, diversity really across the country, geographic region. I would say that in today's market, the opportunity is really there because we have about $2 trillion of commercial mortgages coming due in the next 5 years. Historically, some 2/3 of that has been provided by banks and investment banks.
Right.
Because we've had consolidation in those industries, because capital requirements have increased, and because we still don't know the full implications of Dodd-Frank, they aren't lending like they used to. So there's room for alternative sources of capital to be lending in this market. will be set, call it 50% of our investments will be in first mortgages.
Okay.
Some of them will be in credit loans, probably a quarter of our investments. That would be behind the first mortgage, but in front of the equity. And the last portion of our portfolio will probably be made up of commercial real estate debt securities, whether that's REIT debt offerings or commercial mortgage-backed securities.
And do you have like a sweet spot in terms of like the loan sizes that you're trying to?
Yeah, again, the target is to have a diverse portfolio. We think of ourselves as a middle market lender, meaning real estate that's valued from 15 to 150 million in size. I think as we build out the portfolio, you'll see a few hundred investments in here. You'll see an average of somewhere in the 15 to 20 million size. Those will be smaller earlier on as we build the capital raising vehicle.
And so then taking that like thesis and now presenting it to this kind of an audience, like the investors who may not be as versed in real estate, like how does that communication process work? And do you find people like get what you're trying to do and like feel comfortable with this kind of vehicle?
Yes, I mean, it's interesting in particular because most of our money is raised in the retail channels.
Right.
Certain stories and are easier to relay. I think it's very easy for somebody to understand a net lease vehicle that might own CVS.
We're going to own this building, and I'm going to own it for 15 years, and it's going to have the drugstore.
15-year lease, and it's credit rated this, and that's very easy to understand because every American walks into those every single day to buy something of need, and they know that it's been there all their life. From the debt perspective, most people don't think like a banker, so it takes a little more understanding of where you are in the capital structure. But the interesting thing is, if you like property REITs today because you think it's the right time in the cycle to buy it, by definition, you should feel comfortable with the debt vehicle. Because if a loss occurs, it's the equity holder, the owner of the property, that loses their money first.
Right.
So if you can take advantage of greater demand than supply for mortgage debt today and drive attractive returns, be at the top of the capital structure in terms of where money is distributed, people understand that story. And that's what we're really relaying, is where you are in the capital structure and why you can do this today. Those dynamics don't last forever, but it is a very attractive opportunity today.
Great. All right, well, thank you so much for walking us through some of that. That's great for our audience, great to hear about the session. So thanks for coming by.
Very good. Thank you very much.
And thank you for watching our coverage, and continue to watch more videos from our conference.